your options on different types of stock investing income. So before we get started, make sure to hit that like button. Also subscribes to my channel. What is investing? Investing, broadly, is putting money to work for a period of time in some sort of project or undertaking in order to generate positive returns, i.e. profits that exceed the amount of the initial investment. It is the act of allocating resources, usually capital, i.e. money, with the expectation of generating an income, profit, or gains. One can invest in many types of endeavors, either directly or indirectly, such as using money to start a business, or in assets, such as purchasing real estate, in hopes of generating rental income, and or reselling it later at a higher price. Investing differs from saving in that the money used is put to work, meaning that there is some implicit risk that the related projects may fail, resulting in a loss of money. Investing also differs from speculation in that with the latter, the money is not put to work per se, but is betting on the short-term price fluctuations. Understanding investing. Investing is to grow one's money over time. The expectation of a positive return in the form of income or price appreciation with statistical significance is the core premise of investing. The spectrum of assets in which one can invest and earn a return is a very wide one. Risk and return go hand in hand in investing. Low risk generally means low expected returns, while higher returns are usually accompanied by higher risk. At the low risk end of the spectrum are basic investments such as certificates of deposit, CDs, bonds, or fixed income instruments are higher up on the risk scale, while stocks or equities are regarded as riskier. Commodities and derivatives are generally considered to be among the riskiest investments. One can also invest in something practical, such as land or real estate, or delicate items, such as fine art and antiques. Risk and return expectations can vary widely within the same asset class. For example, a blue chip that trades on the New York Stock Exchange will have a very different risk-return profile from a microcap that trades on a small exchange. The returns generated by an asset depend on the type of asset. For instance, many stocks pay quarterly dividends, whereas bonds generally pay interest every quarter. In many jurisdictions, different types of income are taxed at different rates. In addition to regular income, such as a dividend or interest, price appreciation is an important component of return. Total return from an investment can thus be regarded as the sum of income and capital appreciation. Standard & Poor's estimates that since 1926, dividends have contributed nearly a third of total equity return for the S&P 500, while capital gains have contributed 2/3. Stocks. A buyer of a company's stock becomes a fractional owner of that company. Owners of a company's stock are known as its shareholders and can participate in its growth and success through appreciation in the stock price and regular dividends paid out of the company's profits. Bonds. Bonds are debt obligations of entities, such as governments, municipalities, and corporations. Buying a bond implies that you hold a share of an entity's debt and are entitled to receive periodic interest payments and the return of the bond's face value when it matures. Funds. Funds are pooled instruments managed by investment managers that enable investors to invest in stocks, bonds, preferred shares, commodities, etc. Two of the most common types of funds are mutual funds and exchange-traded funds, or ETFs. Mutual funds do not trade on an exchange and are valued at the end of the trading day. ETFs trade on stock exchanges and, like stocks, are valued constantly. Throughout the trading day, mutual funds and ETFs can either passively track indices, such as the S&P 500 or the Dow Jones Industrial Average, or can be actively managed by fund managers. Investment trusts. Trusts are another type of pooled investment. Real estate investment trusts, REITs, are one of the most popular in this category. REITs invest in commercial or residential properties and pay regular distributions to their investors from the rental income received from these properties. REITs trade on stock exchanges and thus offer their investors the advantage of instant liquidity. Alternative investments. Alternative investments is a catch-all category that includes hedge funds and private equity. Hedge funds are so called because they can hedge their investment bets by going long and short on stocks and other investments. Private equity enables companies to raise capital without going public. Hedge funds and private equity were typically only available to affluent investors deemed accredited investors who met certain income and net worth requirements. However, in recent years, alternative investments have been introduced in fund formats that are accessible to retail investors. Options and other derivatives. Derivatives are financial instruments that derive their value from another instrument, such as a stock or index. Options contracts are a popular derivative that gives the buyer the right but not the obligation to buy or sell a security at a fixed price within a specific time period. Derivatives usually employ leverage, making them a high-risk, high-reward proposition. Commodities. Commodities include metals, oil, grain, and animal products, as well as financial instruments and currencies. They can either be traded through commodity futures, which are agreements to buy or sell a specific quantity of a commodity at a specified price on a particular future date, or ETFs. Commodities can be used for hedging risk or for speculative purposes. How to invest? The question of how to invest boils down to whether you are a do-it-yourself DIY kind of investor or would prefer to have your money managed by a professional. Many investors who prefer to manage their money themselves have accounts at discount or online brokerages because of their low commissions and the ease of executing trades on their platforms. DIY investing is sometimes called self-directed investing and requires a fair amount of education, skill, time commitment, and the ability to control one's emotions. If these attributes do not describe you well, it may be smarter to let a professional help manage your investments. While the concept of investing has been around for millennia, investing in its present form can find its roots in the period between the 17th and 18th centuries, when the development of the first public markets connected investors with investment opportunities. The Amsterdam Stock Exchange was established in 1602, and the New York Stock Exchange, NYSE, in 1792. What do you think of my video? Let me know in the comment section below. Thanks for watching my video.